is 25% off, back in stock. X3 Triiodine exclusively at InfoWarsStore.com. Take action now, but regardless, research this info.
Leading a frontal assault on the lies of the New World Order, it's Alex Jones.
We have loaded phone lines, and it's always great to take your calls. You take us in so many amazing directions. But let me give you a little prelude to some of the other stuff we're going to be covering here today. Cable news ratings dropped to all-time low in their history of CNN. They have less viewers than Newsmax. That's exciting. Old video of E. Jean Carroll, the one that says Trump raped her. The jury found him not guilty, but said he's not allowed to say he's innocent. Confirms she's a wackadoodle in a crazy video we're going to air. We've got a bunch of chilling videos where women now tell 8-month-old babies that asking for milk or touching them is assault. Not joking. It's coming up. We also have Elon Musk subpoenaed by U.S. Virgin Islands as part of lawsuit in the Jeffrey Epstein sex trafficking ring. Is Elon Musk connected? And I'm not an apologist for Elon Musk, but wait till we get to this article. The Virgin Islands admits that they have no evidence he was ever with Jeffrey Epstein or on the island, but that Epstein's documents show he, quote, turned over information from high-value rich people to someone else so that because he's rich, he's now a suspect. Meanwhile, Bill Gates is on the list dozens of times going to the island. He's not being investigated. We're going to get to that. Big article on Zero Hedge. America's powerful intellectual class finds joy in making us obey and be compliant. Warren's top scholar. We've got a backlash. Miller Lite has said, hey, hold my beer to Budweiser. Putting out a video just as crazy as the Dylan Mulvaney video. We've got a bunch of economy news. So much here to cover today. But right now, ladies and gentlemen, we're going to go to your phone calls to Rockstar, Patrick, Zion, John, Pete, Wayne, Steve, Jim, Jordan, Doug, and others. First up, Zion in Maine. Thanks for calling.
Yes, hi. Glad to be on your show. Thank you for having me. I have a bit of breaking news. So with the Title 42, and I know this is a bit off topic, but with the
No, there's no topic. That's why it's totally open phones, any subject you want. I threw out some topics I'd like to hear from you on, but it's open phones, brother.
So with this Title 42 thing, I'm sitting right next to Portland International Jetport right now. And overnight, I actually have been kept up because there have been airplanes, and I know the airplane routes have been coming in from different angles. There's actually big things about noise ordinances near the airport, so they come in different angle. But they've been coming in the old route, these planes, and I'm actually so close to the airport that I can just walk over there and see what's going on. And there is a bunch of black vans and feds and Antifa garbage, and I'm pretty sure they're bringing in immigrants because I've been seeing planes full of people getting unloaded and sent off on buses throughout the great state of Maine.
Well, sir, there's no doubt they're shipping a ton of people to the areas in the East Coast, particularly Maine, and to that big military base that's up there. Is that the airport you're by?
There's no, well, I don't know. But
are you at Bangor?
Here. No, I'm in Portland. That's why. That's a couple hours north.
Yeah, well, but this is what I love. You know, you've called in with an anecdotal example, and that's important. That's great. Sir, it's confirmed hundreds of thousands a month come across. They put them on planes and fly them across the country. So, yeah, they have secret 2 in the morning flights to New York, to Florida, to North Texas, to California, to Maine, to Michigan. Every state they're flying them to. So, yeah, I mean, if you're seeing vans pull up in the middle of the night for a bunch of planes that only normally land there, you should go up to the fence and get video of it and put it out. But, yeah, I mean, of course it's going on.
That's what I'm going to do tonight. I'd be glad to send it to y'all. I'm going to put it on my channel and everything.
What is your channel? And CC it to showtips at Infowars.com. But what's your channel?
My channel is MAGA1488. I'm on YouTube and on Rumble.
Well, do it, brother. That is what you should be doing. But, yes, it's going on. It's happening. Our government facilitates the illegal invasion. Thank you, Zion. John in Texas, you're on the air.
Hi, Alex. Well, 4 weeks ago, I came down with a virus. On Monday, it started out as a small cough. Tuesday, it was a major cough, and it just took a nosedive right into my lungs.
Oh, yeah.
Now, for 8 days, I couldn't lay down and sleep at night because all my lungs were gurgling, and I was coughing. I had to sleep in a chair for 8 days.
Yeah, that's COVID. Yeah, and they say COVID's dead. It's not. It keeps mutating because they gave us vaccines that caused the mutation.
Well, my lady friend's daughter, who's a school teacher in Austin, has been going through the Austin school district. She came down with it. She went to the doctor, and they took tests, and they said, well, it's not the COVID. They said, we've never seen this before. We don't know what it is.
Yeah, because once it mutates, they can't track it with that test. But it's a mutation. It's happening everywhere. There's more COVID deaths this year than last year. And it's not them killing folks with ventilators. They created this mutagenic system.
It took 8 days. Luckily, I know everything about vitamins.
Believe me, you don't have to tell me about it. I've never had anything like it when I had it 2 years ago. People say it isn't real. They're full of crap. It is something else.
Well, I've had the regular COVID. I've had the Delta variant, and I had the Omicron a couple times, the milder version. This was worse than that. There was a couple days where I thought maybe I ain't going to make it.
I hear you. It's scary as hell. No, they've hit us hard, brother. And they're using the COVID release as a cover for a bunch of other stuff they're releasing, believe me. And that's what they mean by, oh, it's over, the new thing's coming, is because they are mad scientists, eugenicists, John. And, John, I recognize your voice. You've been calling decades. So good to have you call. I'm glad I didn't kill you, brother.
Yeah, I'm glad I'm still hanging in there, too, Alex.
What'd you take? Because let me tell you, inhalable steroids, ivermectin, zinc, hydroxychloroquine, ivermectin work like a charm.
Yeah, well, I took vitamins, anything antiviral, the supplements. I took quinine water. I boosted it with my own home-brewed quinine, boosted it up. I took 4 aspirin a day. And of course, the Dr. Zelenko, when I had the Delta variant, when Dr. Zelenko was on there, he basically saved my life because it was going down on my lungs, too. And when I started taking quercetin after he told me, it came right up out of my lungs and it went away.
Well, that's right. And we have a lowering life expectancy worldwide. They have hit us. Did you hear about the military 500% increase in HIV since the vaccine?
Yeah, I heard that. I heard you talking about it.
I mean, they are, brother, they are hitting us hard. Good to hear you're better, John. God bless you. Yeah, it's bad. These bastards. In fact, a bastard is a great person compared to these people. That's not a fair name. These murdering, satanic criminals. Steve in Tennessee, you're on the air. Go ahead. Oh, nope, got to go to break. Sorry. Didn't look at the clock. We're coming right back to you, Steve. Everybody else, the orders, your calls are received. Infowars.com, band.video, newswars.com. Have you shared those links? Because you're the real power. When you decide to get off the bench and take action, nothing stops you. You don't, we lose. Share. MadMaxWorld.tv. MadMaxWorld.tv. It's one word. MadMaxWorld.tv. Ladies and gentlemen, the truth, the solution is laying right there in front of you, hidden in plain view. Please listen to me in the next 60 seconds. If you go to Wikipedia, it has links to the UN's own website where they admit the #1 cause of cognitive disability in the world is iodine deficiency. The #1 preventable cause of intellectual disability is lack of real pure iodine in the body as they bomb us with the bad halogens, bromide, chlorine, and so much more. Upwards of 2 billion people in a Lancet Medical Journal study in 2007 worldwide have cognitive disabilities because they don't have high-quality iodine. Most iodine is bound to other elements. You don't absorb it. We have X3, all three types of the good iodine together that supercharges your body. X3 is now back in stock at InfoWarsStore.com. It's being sold out for over 6 months for 25% off. X3 back in stock. Take action now. InfoWarsStore.com.
InfoWars. Tomorrow's news today.
This is their big move. So, yeah, you say, why doesn't Biden address the disasters in the United States? He doesn't care. That's not his job. He's not the president.
I am joined by an expert in macro and banking, Patrick Parrott-Green, founder of PPG Macro. Patrick, you've been a veteran of trading rates in Asia, working in bank treasury departments. Started working on your own, over the past, close to a decade. Great to have you here. Welcome to Forward Guidance.
It's great to be with you. Thanks, Jack.
Patrick, I want to start by just showing the audience something that was on your radar very early. In the fall of 2022, last year, you wrote, liquidity warning, small U.S. banks for commercial real estate loans and non-bank liquidity, basically showing that base liquidity at smaller U.S. banks had plunged, and you had sent these to your clients at PPG Macro. And as people can see, circled in red, is you sent this on October 5th. About, let's say, 5 or 6 months later, we started having all this banking turmoil. So needless to say, this email has aged quite well. What was it that you had seen, in the summer and fall of 2022 that was getting on your radar, getting you a little bit worried? And then, what have you made of the recent fallout?
I'm a sort of a bit of a geek when it comes to the sort of monetary data. So every week, religiously, I'll go through the H4 report and the H8 report. The H4 obviously being the Fed's balance sheet report that comes out every Thursday, late on Thursdays, and the H8, which is about the commercial banks and their assets and liabilities. And obviously banks' balance sheets are both on assets and liabilities because of everything to do with the pandemic. And in the US, particularly because of fiscal largesse, saw these dramatic changes, excess liquidity, yada, 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 very high balances on cash, and deposits. But deposits have been falling consistently. Reserves have been falling consistently since the beginning of last year. And it was basically, you get to the point where you just go like, loan deposit ratios for big banks have generally trended downwards pretty consistently, but small banks started to pick up. Their lending picked up very quickly. And as we now know, when we talk about Signature and SVB and First Republic, or Worst Republic, and actually I would just one little sideline on that. I would say the Worst Republic is definitely California or the San Francisco banking district, because so many of those problems seem to be centered there. And the funny thing is, it doesn't look like they've improved over the past 16 years, when again, so many of the problems were in the San Francisco banking district. So there was just little warning signs that their liquidity ratios were dropping. And we're very clear that commercial real estate was already starting to suffer. And ever since then, we've seen far more stories, far more sources of woe. You've got big private equity names. And, I'm not going to talk about I could talk about the Black Death Star, as that's how I call it, Blackstone. But it's more when you've got the likes of PIMCO and Brookfield handing back the keys on commercial buildings and just walking away, all is not well with the world. And then you have to question, okay, banks are supposedly well regulated and supervised. Well, we've just had the Fed do a mea culpa about that. And we've got a situation where smaller banks, and it's very arbitrary the way the Fed describes it. It's basically anything bar the largest 25 by asset basis. Well, I haven't seen the latest ranking, because obviously 3 of those banks or two banks that are in the top 25 have disappeared, SVB and FRC, and Signature were number 29. So there's a shuffling up. But it's quite a crude definition, but small US banks are disproportionately exposed to commercial real estate. So while they only have something like 30% of the banking assets, they have 70% of the CRE loans. So they're basically stuck with a liquid product. How much of that lending is floating and how much of that is fixed is hard to say. How much of it's hedged? I mean, I can't remember which Fed it was recently put a paper out about the lack of interest rate hedging amongst banks as well. If I'm Citibank or a big bank, basically the top four, the losses on my available for sale portfolio is a direct hit to my capital. Smaller banks, it's not. Hold to maturity isn't, so it's just there as a great big blob. But even at the end of, I think at the end of the fourth quarter, the FDIC said that the unrealized losses of both portfolios of the US banks was well over $600 billion. So roughly about a quarter of the actual capital of the US banking system. So there's lots of little flags out there. And as liquidity was draining, big banks were continuing to do well, very high levels of deposits. Yes, they were coming down, but the loan deposit ratios were fine. They also are generally well managed, well, vastly better managed than they used to be. So I, for example, was working at Citibank in 2007, and we used to joke that the term chief risk officer was an oxymoron. So they've improved enormously. The problem is small banks have grown rapidly. It's very clear from the Fed's post-mortem that while their assets exploded, their oversight didn't accordingly. So you double the size of your balance sheet, but did you actually add any more to your risk team? Well, in fact, in SVB, they didn't even have a chief risk officer. So, I mean, we're talking about, so one is that sort of, yes, we're expanding because everything's great. It's a buy everything. Rates are low. We're making loads of money. Look at our NIM. But all of a sudden, actually, those big mortgages that First Republic gave fixed at 3% or wherever they gave them to the billionaires or multimillionaires. And all of a sudden, we're borrowing the discount window at 5%. So, and then we end up on the road to bankruptcy. And the problem is, even allowing for deposit insurance, and the great majority of deposits in the US and for SMEs, they don't even challenge the 250,000 limit. So extending insurance is really just another sop to the elite. If you've got more than $250,000 in your bank account, you should be financially aware enough to understand the risks. I think that's a reasonable approach to take. But the problem is, there is that fear of contagion. I mean, it's just things were getting dicey, and then as more and more data came out, so then you could see actually that technically, even at the end of 2022, First Republic was already in deficit when you added up its valuations of on its losses and its loan book and everything else, and its rates as well. So one of the things I noticed when I was looking through First Republic's results, because they put the rates of their investments, is actually, it turns out during 2022, they were actually selling bonds that were in the money. And so the average rate yield they were getting actually fell. It was lower for Q1 23 than it was in Q2 22. So they're basically, to keep the hamster on the wheel, they'd actually been, wherever we can realise a profit, let's realise a profit. To hell with the ones that are in loss. We'll just ignore those. Classic. It's like the classic bad gambler.
Yeah. So Patrick, just to explain a few things. So you said fixed versus floating. That's fixed rate. When you have a loan, you get 4% every single time versus variable rate, floating rate. Oh, if interest rates go up to 5%, now you're getting 5%. That's key on the asset side because as we now know on the liability side, what banks are paying is changing rapidly as the Federal Reserve raised interest rates from 0 to 5%. You also said available for sale, AFS versus held to maturity, HTM. And then NIM is their net interest margin, the spread between what they get on their loans and what they have to pay depositors and on their liabilities. So when you talked about First Republic, the problem was a NIM problem. They just were not earning enough on their assets. They made mortgages to very wealthy people at 2.5%, 3%, and so now they have to back when they existed, unfortunately, they had to borrow from the Federal Home Loan Bank at 5%. So they have a.
You just think about the value of that loan is just like the value of the price of a bond.
Right.
So if rates go up, the price goes down. So you've got. It's not just a NIM problem, but you've actually got a mark-to-market problem. If you're a liquidation point, then you're just going to realize a huge loss and be bankrupt.
Silicon Valley Bank, they had that problem in mortgage-backed securities. They bought all this paper that yielded a low rate, and so the value went down. You wrote today, something smells in the banking system. I mean, how do you think this plays out, and to what degree do you think this crisis seems over? Because you can make a case. First Republic fell, but that was the last bank to fall, and credit quality so far seems good. Yeah, what do you make? How do you respond to that case?
Well, for a start, all these things have happened when the economy hasn't been in recession. So there's another element as well. So far we've just talked about the prices of fluctuations in the value of securities, NIM, all that sort of stuff. But what we haven't even touched on is the coming hit in delinquencies as well. So that's the other side of it. When the bank, and we're already seeing things like credit cards that, particularly amongst younger demographics, as the delinquency rates are already surging, while they're getting away with so far 38 months of forbearance on student loans.
Surging from very low levels, though, right? It's like if delinquency rate is 10 basis points and it goes to 20 basis points, the delinquency rate has doubled, but it's still not high.
Oh, no. I mean, some of the stuff now, I was seeing on Twitter today, when you were back to sort of 2019 levels of delinquency. On subprime, we're back on subprime credit cards. We're actually at higher levels of delinquency than we were in 2019. So we've got these other kickers, income growth is slowing. Excess savings have largely disappeared. San Fran Fed did an economic letter on Monday highlighting that excess savings were down to 500 billion. The problem is those excess savings are really just left with the rich. So they're not going to consume those so much. And actually, if you just deflated it as well, the number's even less. So if you think about it, excess savings were 2 trillion and we're down to 500. So they've effectively, because they had this huge boost largely from Uncle Sam, that's roughly 6% of GDP. So no wonder consumption has remained reasonably strong. But now that process is clearly coming to an end. So as growth starts to slip, and a lot of our high frequency measures, I'm a big fan of freight data because it's live. And I was just reading something today from the guys at freightwaves.com who I think are a go-to source of data. That rates have just actually, they were hoping that we were going to get a spring liftoff as we normally do. And rates have actually just cracked to new lows again. And they do these things like the rejection rates, i.e. how many truckers are turning down contracts and are hitting new lows as well. So we know freight is exceptionally weak. We know that inventories are extraordinarily high. So, for example, the inventory sales ratio for merchant wholesalers was only, let's exclude pandemic skewed data where you get these ludicrous spikes in activity, etc., was only higher in 2008. So we've got a massive excess of inventory, which will have to be worked down. But again, it just when you look at those sort of ratios against inflation, they say it points to much lower inflation. If you look at the New York Fed's global supply index, that came out, that's out this week. It's at a new low. And funnily enough, it's got a great correlation with Chinese PPI, which also came out today, which fell to it's down 3.6% year on year. And China is the world's producer. So that's another side of things. So let's just say we do go into recession, but then the delinquencies start to really kick in. And the problem is then nobody has any money. Jamie Dimon may have got a deal on First Republic, but don't think that you're going to get lots of other banks running to buy up assets of banks that run into difficulty. So when you see the story in the FT today about Blackstone offering to act as an intermediary between banks and insurers to try and shift loans, sell loans onto insurers. Insurers is just going to go, well, hang on. One, I don't really want to buy those loans. So yes, long term, there's talk of us getting more stuff in private credit. But if I think we're on a recession and lending starting to particularly tightened, and we know delinquencies are going to be rising, then why on earth would I want to buy a loan unless it's very attractive? And two, if the bank wants to make it attractive enough to sell, he's going to have to take a big capital hit on the value of the loan in the first place. So it's sort of like, and getting Blackstone involved is, like saying to someone earlier on today, is like putting the fox in the hen house. When you look at their own problems with their REITs and lots of their commercial properties. So that's another
Patrick,
issue.
so I want to ask, people talk about the Blackstone B-REIT, real estate investment trust, where people who want to withdraw their money, there's a gate. Oh, you can only withdraw X amount of X billion dollars per month. That sounds bad, and it is bad for the investors. But for systemic stability, it actually can be good because people can't call their money all at once, right? Unlike a bank where people can, and you have a disaster, as we've seen 3 times just over the past few months. So, I mean, I know it sounds a very cynical argument, but the investors are, they've been tied to the mast, so to speak, and so they can only withdraw so much. So Blackstone won't be forced to sell.
Yeah, that's all right. That's all well and good. So what do if they need cash? They go and sell stuff they don't really want to sell, or they reduce their activity and they preserve their capital, which in turn reduces overall economic activity, which then makes the recession worse, and all their assets fall in value.
Yeah.
So, I mean, you don't get any great, when it comes to this sort of environment, ultimately it's every man for himself. The collective, there's no kumbaya spirit around.
So I want to ask you this. Will more banks fail in the U.S.? How many? Are they regional banks? What do you think is going to happen?
I think, yes, we will see some. But, their asset size is low. I mean, the big banks are solid. My real concern is not so much the banks. I mean, they are vitally important for a huge chunk of the US economy. So you think about, SMEs, or the way that large companies. So generally, the definition is 500 employees or less, or a turnover of sort of less than 25 million or less. Those companies which don't have access to to the investment banking world, they just live with, they're dependent on their banks, and it is their regional banks. So if the regional banks are feeling pressured, as we see with the senior loan officers survey, well, you go along for a loan now. One, the bank's going to want more collateral, or a higher level of, it's going to want more collateral, or a lower loan to value mortgage, whatever, rating.
Or a higher loan yield.
And also one of the biggest, while people say, oh, there wasn't that much change in the senior loan. Reality is if 55% are saying, yes, we've got tighter conditions from the previous condition, it's still very strong. But what we saw, particularly in the latest one, was a very significant rise in the cost of credit to be charged. So then you go along and you think you're a businessman. You go, okay, we want to expand. We're doing quite well. We haven't got, we need to borrow some money. But then you go along to the bank and he goes, well, I want the X, Y, and Z. And then you do your math and it just no longer makes sense from a business person. So you don't invest. And so that's, in turn, growth is reduced. So, it's just this gradual circle that just carries on.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. Yeah, so Patrick, I took, as someone who's not an expert at all, I just looked at the senior loan officer survey, compared the numbers to 2007, 2008, and it seems like it's in, maybe late 2007, early spring, winter 2008 levels, not the 2008, 2009 levels. It's important to say it is I don't know if it's a diffusion index, but they're asking people about a relative state of change. So, if there's a 7-foot tall man, and then you say the next data set is a 6'11" man, you say, oh, he's shorter. So the data says, oh my God, the data says he's so short. No, he's 6'11". Likewise, we had a record credit boom in 2022. People say we had monetary deflation in 2022. They are wrong. Look at the chart of loans and leases in 2022, off the charts.
But yes. That's one of the problems. You see, that's one of the real problems about that. So one of the reasons that bank lending actually grew in 2022 was because of the collapse of issuance in markets. So if you look at high yield issuance, it's an absolute fraction of what it was and also a lot of the, if you think about the mortgage market, a collapse in origination. I mean, origination, I think in 2021, because of all the refi, etc., was roughly, I think, something of the order, if you look at Knight Black, I think it was of the order of like $4 trillion. And then of actual new originations was probably about 1.6 or 2, but then purchasing dies. So actually overall credit creation slowed dramatically, but for the banks, one, non-banks were no longer able to compete. So people had to go to the banks. Two, rates had gone up a lot. So not only were rates higher, so they were able to make more of a profit, the bigger margin there, but also they were able to widen their spreads because the competition from the sort of the investment banking world,
yes,
the non-bank world, had largely dissipated.
And what they paid on deposits was still close to zero because rates were still zero on the short end. Yeah.
So they were still flush with liquidity. The problem is that liquidity is an ephemeral concept. It's there until it's not. And just think about it. I often describe it is, so people talk about reserves or narrow money versus broad money and all this sort of stuff. The best way for it to look at it is it's like the oil in the engine of one's car. And the problem is, as some of these banks did, they kept on driving down the highway, doing 70 miles an hour or speeding, a lot of them, and they forgot to check their oil levels. And so what happens? Your engine blows up in the end. And I think it's a pretty accurate metaphor for some of the banks out there. And now, of course, they're scrabbling for liquidity. So they're going to the Fed or they're trying to raise funds and they're having to take, which are expensive. And they're basically locking in losses or reduced income, which also are going to affect their earnings and their overall value. And they're just, and as I said, we haven't even started to hit the default cycle, the delinquency cycle.
Bank lending, that chart that we can show up, exploded in 2022. You made the excellent point that that's because other forms of capital raising in the capital markets, issuing bonds, convertible notes, raising equity, that froze in 2022. But I would make the same point. In 2020 and 2021, you had a record bubble in high yield debt issuance, investment grade issuance, IPOs, SPACs. So the huge contraction in 2022 was from a ridiculously bubblicious high itself, in the same way that the contraction in credit now is from a bubblicious level in 2022.
Yeah, but what we're also seeing is an awful lot of that issuance. So we look at CLOs or the CMBSs that were done then, they're actually very short term. High yield debt is very short term. So already you're now, seeing people with CMBSs, and you're finding this, we're seeing that in commercial real estate, that they're coming to refi. And even not only those, the Vornados of this world with their rate locks. And so the big property managers, there's not just issuance, but they took out rate locks. But being greedy, they just go, we'll just take a 3-year one. And now they're having to the rate lock, and they're in difficulty as well. So you've got a refinancing factor here. So there's some real problems starting to kick off in CLOs. Mm-hmm. And I was reading an article yesterday about how, for once, people generally think that, high yield is more risky than CLOs. Well, actually, what we're seeing is CLOs doing worse than actual high yield. So if you look at HYG, for example.
Right.
So there is this whole issue of the non-banks. And this is and I think people, BIS, the Financial Stability Report writes about it. But what we have seen since 2008, it is an explosion in the assets put into the private equity / shadow banking world with higher beta models. And we've also got this big problem, and I think this is one of the things that I said to a now retired Fed president last October. He said, well, if you think about it, if you were 30 in 2008, and let's say you hadn't bought a property yet, and you're now 45, you've spent your entire mature adult life in a low rate environment. You've perpetually conditioned yourself to having to spend a relatively low percentage of one's income to service one's debt. And now we just had the biggest monetary tightening globally. Probably actually, it's even great. So we can talk about high rates in the early 80s and stuff like that. But rates were perpetually high. And so if rates went from 12 to 15, yes, it's painful. And I remember having a mortgage in the UK in 1989, and it was 15%. So, but a relative shift was minor. But here you've gone from, rates were at zero. Actually, the shadow Fed's funds rate, according to the San Fran Fed, was like -1%. And now the shadow Fed's funds rate is closer to 7%.
And the shadow Fed, what does that take into account? Just things that...
Well, it's more a question. It's a sort of, it takes more allowance of spreads as well. So actually, if you look at the shadow Fed's funds rate and overlay it versus the mortgage rate, it actually has a better fit. And if you look at the spread of between the 30-year mortgage rate, or the average 30-year mortgage rate, and the long bond, now it's wider than it was at the peak of the GFC. 30-year mortgage rates are what, 660, 670, and we've got a long bond at 373. So 300 basis points differential.
And that probably has maybe something to do with quantitative tightening, because the spread between MBS, mortgage-backed security spreads over treasuries, that's affected by quantitative easing, but no.
A little bit, but actually, because of the lack of activity and origination and refi, we're not getting actually much roll-off. And actually, the bigger factor that actually makes our MBS, actually, I personally have been talking to clients for a long time, really for the part, since November, and we had a big rally in it. But over now, if I was a fixed income portfolio manager, I'd be buying RMBS, because I'm not too worried about, the AAA agency. Or
not worried about rates going higher, yeah.
But origination has collapsed. So the collapse in origination in MBS has had a far bigger impact than the actual any rolled off by the Fed's balance sheet.
Right.
It should be positive.
Future. So CLO, you said earlier, that's collateralized loan obligation. CMBS, commercial mortgage-backed security. VNO is a Vornado Real Estate Investment Trust. The VNO is the ticker. The stock has fallen quite sharply. BIS, Bank for International Settlements, a central bank for central banks. Although, I talked to someone who used to work at the BIS, and he said, central bank for central bank sounds important, but really all we did is write papers and have meetings. But
well, they do great papers, and this is another issue I want to talk about. Yeah. I want to talk about. So we talk about the problems of overall liquidity, but there's the global impact as well. So basically, there's this big argument. Oh, look at the size of US money supply relative to from where it was. But actually, if you look at against nominal GDP, it's now back to trend. So we've had this ever rising trend of increased money supply with nominal GDP, and the percentage has got higher. So it's every year we need more debt money to create a unit of nominal GDP growth. So it's back to trend now, but the reality is there's this argument about, is it about the size or is it about the flow? And I'm much more of a flow man. So we now have US money supply, nominal money supply, falling properly for the first time since before World War II.
Yeah.
The last time that happened was 1937, and you ended up with a very nasty recession. So US money supply has fallen for the first time since before the World War II. Look at it from the perspective of all the economic research is done, all by central banks. I mean, I look at central banks, and they're all. Doesn't matter if you work for the ECB or the Bank of England or the Fed. They're all the same. They've all got their masters in economics, gone and done their PhD. Most of them don't know how to change a plug or a tire. There's a sort of generic gene pool of them. And going back to this Fed president, I said, well, only worried about, what about money supply? And he literally rolled his eyes at me as if it was like, oh no, we don't talk about money supply anymore. No matter that the greatest Federal Reserve chairman in history, Paul Volcker, was a massive believer in it. It was like, oh no, forget Volcker. He didn't know what he's talking about. Right, okay, fine. Yeah, what have you done? But I don't think. I mean, I struggle. I look around and I try and find a Fed paper that talks about falling money supply and the potential consequences of it. There isn't any, partly because they never consider it would happen, and secondly, they've sort of dismissed monetary economics. So this is another problem. Another concern I have is that central banks don't have a playbook for this, unless they go back to, oh yes, let's print more money, but the political appetite for that is negligible. So this is why I had a sort of constant theme that we're into the unknown here. And it's not just US money supply, it's UK money supply, it's European money supply. M1 in Europe is down 4% year on year. So obviously we only have 20 odd years history of Eurozone data, but it certainly doesn't smell right.
Yes, it doesn't. Patrick, could you explain in a relatively simple way, as simply as you can, why the money supply is falling? It sounds, the last time it happened was during the Great Depression, but it's, now banks, it's not that banks are cutting off making loans entirely. They're just slowing loan growth. Does it have to do with quantitative tightening at all? Like why?
Oh, absolutely. Oh, no, that's a big factor because the money is just disappearing. Fed issued reserves on the back on when it bought bonds. We're cancelling bonds. I mean, what we're seeing, if you look at Europe, is actually the ECB has reduced its balance sheet by a much greater stage than the Fed has. The ECB's, in a matter of months, basically locked 1.1 trillion euros.
Right, but Patrick, that's, you'll correct me if I'm wrong, high-powered central bank money. When you talk about money supply contracting, I think you're talking about a form of bank deposits, which are the liabilities of commercial banks, not the liabilities of the Fed.
It all has an effect because you get excess reserves sitting on banks' balance sheets that they have, so that's on one side of the balance sheet. So you've got to have an offsetting. So that's a liability. So you need an offsetting asset. And as those liabilities fall, you reduce your assets. So that's one of the ways it just basically functions. But it's there are other measures. So, for example, Lacey Hunt is a big fan of other ODLs, other depository liabilities. ODL is collapsing at an unprecedented rate. It's absolutely collapsing. So if those liabilities are collapsing on one side of the balance sheet, it's much harder for me to increase my assets. So I'm going to reduce the amount of lending I do. I'm going to just be more cautious. And this is some of the problems that we've seen. So when we look at the loan deposit ratios of small banks have absolutely leapt because deposits have gone down. Mm-hmm. Loans haven't really fallen yet. But people will talk about, but loans are still growing. Well, that's a lagged effect because if you think about it, you take a loan, you apply for a loan. You don't necessarily draw down on that instantaneously. I think we're only going to really see the effects on lending over the next 3 months. We'll start to see that effect come through. But overall, and then we look at foreign banks in the US, and their loan deposit ratio is now at a record high. So that's another area? Because foreign banks.
Wait, sorry, Patrick. Explain what's going on. So you've been tracking the foreign banks within the U.S. and what they've been doing in terms of their liabilities, their assets is very strange. Explain in a very simple way what you've been noticing and why it's significant. One of the issues is that the foreign banks, of their $1.2 trillion of deposits, 60-odd%, something like 760 billion of them, are what the Fed classifies as they're basically other assets. I got you. They're term deposits, large term deposits, which are their definition is over $100,000. So basically, they're going to be more than $100,000. So those are largely uninsured. So if you're a corporate, you're a corporate treasurer, you have your international banking relationships, but at the same time, being a corporate treasurer, and I've seen what's happened to Credit Suisse, I've seen what's happened to smaller banks. There's no upside for me keeping in a bank what I need apart from my immediate budgetary needs, let's say a month's worth of expenditures. So just on a career risk policy, why not put my stuff in a government money market fund and protect my liquidity? So you could so we're keeping an eye on this one because initially the foreign banks didn't see any effect. So we had the problems in March with the domestic banks, but then foreign banks have only really started to see large deposit outflows in the past 4 or 5 weeks. If that continues, they may have to start going to the Fed or trying to raise liquidity elsewhere or try and get money from their parents. Or as we look, and if we look at what happened with Credit Suisse, we saw the expansion in swap lines. And of course, the Fed doesn't say it's the SNB, but we all knew it was the Swiss National Bank. Yep. Providing liquidity. So keep an eye out. Will swap lines start to be tapped? That's another sort of tension. Then that will lead off to strain, but it has financial stability effects, but you'll see credit spreads come under pressure, cross-currency basis will come under pressure. And generally, that would actually strengthen the dollar. And also, we're at a time here where everyone's gone, the Fed's going to pivot first, look at rates. Well, that's all in the price. We look at forward rates. So the painful thing now would be for the dollar to actually go stronger as well. Well, basically, if you think foreign banks are short of dollars, they may have to go to their parents, to go to central banks, to utilize swap lines to then lend them dollars. But they're also going to curtail their activities. But that can lead to strains in FX markets and broader risk assets. And then we've got other issues as well, which may exacerbate a dollar rally, as what's going on in China as well. So if you notice in the recent FX rally or the dollar weakness, the one currency that hasn't really participated has been the Chinese yuan. So if you look at Euro CNH, which is the main cross, that's right up at its highs. But that's also, China's got deflation, certainly in producer prices, which is the only price measure that counts the rest of the world because it is the provider of goods to the rest of the world, but also it's a massive competitor with the other major export country area, which is, of course, the Eurozone. Patrick, I just want to just clarify on the non-U.S. banks active within the U.S. on the liability side and the asset side. Okay, so on the liability side, they don't have a lot of retail depositors. They've issued wholesale deposits, CDs, certificates of deposits, as well as deposits over $100,000. So that's on the liability side. So they're the most vulnerable. On the asset side, who are they making the loans to? You said it's a lot of commercial loans.
They'll be basically providing financing to corporates. It's as I said, it's if you look at their balance, 50, almost half of their loan book is C&I. However, more recently, they've also, over the past year or 2 years, they've increased lending to what's called classified as other non-depository financial institutions. So that could be a hedge fund, it could be a private equity fund. It takes money. Probably often much of that is actually used for leverage. And then there's another area which is basically other unclassified lending, which is also soared. So we know it's not C&I, and we know it's not towards residential or commercial real estate. It's just a great blob.
Got it. Okay, so Patrick, thanks. Now let's move on to, you called the European Central Bank hike of 2008 a economic war crime, and you said that the ongoing rate hikes from the Federal Reserve or the ECB were the same thing. Why are they an economic war crime to hike interest rates during a bank recession, during a bank turmoil?
Well, one, the flow of credit is already diminishing. Two, central bankers are always telling us that the lags of monetary policy are long. So if you get one bad inflation data, given everything's now turning south, that's going to, it has no effect whatsoever. It's just it's like a meaningless gesture. Oh yes, look at us, we're being credible, but we've already put so much tightening in the system, both in rates and in terms of QT and tighter credit conditions, that sometimes, it's like baking a cake. You don't turn the oven up to speed the cooking of the cake, otherwise you'll burn it. Or Tereo used it, Milton Friedman's phrase about, the shower's not warm enough because you're waiting for the water to come through and you end up scalding yourself because you increased, and it's very much that. So we are at a time for patience. And I would actually argue that, sticky inflation and some of these things have made them possibly over-tighten, whereas they probably should have just been clearer in their messaging, which has always been a problem. But actually saying, well, we've done a hell of a lot and it's time to just, and I think we are at that point now. But I mean, in 2008, we could see what was going on in the world. We'd already had loads of bankruptcies and banks failing. Got worse, obviously, when Lehman went down and then the UK banking system went down as a whole. But, you had this knee-jerk reaction from the ECB because the oil price was at $140 in the middle of 2008. So headline inflation was out there. It doesn't matter that money growth had been declining significantly for well over a year. The M1 in Europe was down to 0%. And the monetary conditions were already very tight. So it was just like a futile, World War I, let's go over the top.
Trench.
When you've got no
warfare.
chance of getting across no man's land.
It's a pretty grim analogy. Is that a grim analogy apply here as well?
I think, well, put it this way, if the Fed hadn't done what it's done, we would not have been seeing the pain that we've seen in banks. The problem is, we've obviously seen a huge amount of change post-pandemic, with, there's been a shift in the efficiency of the office spaces. Also, there's been big trends behind that, i.e. pre-pandemic, people were still wanting to move to more green, energy-efficient buildings. So, you just go to Manhattan and you see these big old 50s, 60s, 30s blocks that they just can't do anything with. They actually some of them actually haven't, because you can't convert them to residential on a cost-effective basis. They actually have a negative. Once you actually sort of add in the demolition costs, they'll probably have a negative value. So they just sit there vacant. I think there's a big one on sort of Broadway at the top of it. It's near Central Park. And it's just, they can't give it away. So that comes to all these other loan books. So people say, oh yes, US banks, their loan books are solid, well managed, but some of this stuff, the shift in valuations we've seen are enormous. So there's the Union Bank, their headquarters in San Fran, 2019.
Just bought by US Bank, right?
Yeah, well, I mean, I have my own concerns about US Bank. And even the other ones. I mean, so why is it, Citi, I think I saw it on Twitter today, Citi are paying like 0.1 on an instant deposit account, an instant access account, and PNC is paying 4 3/4. So why is the 6th largest bank in the US having to pay 4 3/4? But that's another story. But the Union Bank building, so they own it. It was well maintained. You could depreciate it. It was valued at 300 billion, I think, and it's just sold for like around 300 million. It's just sold for 65. And that is not a distressed seller. That's not a bank in possession. When banks, and this is the other thing, when banks start receiving stuff, they are not, from a regulatory perspective, they're not allowed to become long-term landlords. So they have to get this stuff off their balance sheet. So they provisioned on loans. They may lose some more money, but basically they just...
So they would be a distressed seller, whereas this bank, Union Bank, owned the building, which was just bought by US Bank. What are your concerns on US Bank? Warren Buffett has owned it. Bank analysts I've talked to think very highly of it, at least historically, perhaps not now.
Yeah, you mean the same bank analysts who all had FRC and SVB on their buy recommendation lists until they didn't.
Okay, but Warren Buffett didn't own First Republic. I mean, the return on equity of U.S. Bank is a reason. I mean, it used to trade at a higher price to book value than J.P. Morgan.
It still looks expensive to. I mean, I don't really do stocks, and I try and avoid. But basically, a common feature amongst all the banks that have gone bust is how rapidly their equity capital relative to their assets has declined over the past 2 years. And
that is almost entirely because of interest rate risk, not credit risk, correct?
Well, no, because they expanded their assets and, not bolstering their equity.
What bank has failed because their loan book went bad? I would say none so far. I'm not saying it won't happen, but correct?
Yeah, they just ran out of liquidity. They ran out of, their model, borrow short, lend long. But also there is this element about, how much capital is in the bank? So how much reserve do they have? How solid are they? And a common feature amongst all the banks that have gone bust has been the fact is it's the rapid decline in those ratios over the past 3 years. So you can look, I've tweeted about them in the past, put them up, and you can look at a lot of the ones that are under pressure now, so PacWest, Comerica, or whatever, have very low equity to capital ratios. They're sort of around about 6%. So, do they actually, if you take their losses and all the other stuff, do they actually have any capital left? And then you go, if the net position is their capital less, then they shouldn't be running it as a bank. Otherwise, they go and raise capital and solidify their balance sheet and take a hit on their returns. I mean, there are 2 ways you can run a bank treasury book. And if you're working in obviously you want to maximize the income. At the same time, you always have to have an eye on prudence and your regulatory liquidity obligations, and that comes obviously at the cost of reduced returns, certainly in that area. And unfortunately, my perception is that too many banks have focused on using the treasury operations as the banking operations as a profit center, and have failed to spend enough attention looking on as how a bank treasury operates as a liquidity center.
Right. So you have the common equity tier ratio. They said it was 12. It turns out it's actually 6 because all of these risk, low risk assets such as agency mortgage-backed securities.
Well, no, it's just large part of it is down because their asset base has expanded so much over the past few years. So
right, and those asset bases that they bought are now worth less in the market. So they have
Yeah.
No, I see what you're saying. Okay.
It's just basically how much gas does a bank have in its tank?
Yeah.
And the problem is, as we've seen, in this digital age, which was the other thing that Powell fessed up to, was, now the fact that everyone's got a smartphone, which they didn't have in 2008, and most banks you couldn't bank online in 2008.
Yeah, you'd have to drive to the bank, wait, it's a hassle. Why not just go take a nap instead of doing it? But now you can just do it from your
you just go click, bang,
when you take a nap.
Move it.
Yeah, so Patrick, you're absolutely right that banks swelled in size, particularly Silicon Valley Bank. I think they close to tripled their asset base, and that should appear as a higher leverage ratio. But they were buying all these assets, agency mortgage-backed securities, that had a risk weighting of 20%. So it didn't appear in what they were reporting as much. And maybe agency mortgage-backed securities, maybe they should have a higher risk weighting. There's a bank analyst and investor I respect a lot who has a quote something to the effect of, show me the risk weighting, show me the low risk weighting, and I'll show you where the asset problems are. Because, in Basel II, I think, banks could have AAA subprime mortgage-backed securities at a low risk weighting. Now you can have agency mortgage-backed securities at a low risk weighting, and the credit risk is, infinitesimally small, but the interest rate risk is huge.
Well, I think that would actually, the question I would raise is actually that bank regulators probably focused far too much on the credit quality and not enough on the interest rate risk. So interest rate risk should have a higher weighting when it comes to measuring banks' position as a whole.
I couldn't agree more.
If you're going to rate a bank.
The talking heads on all the channels were saying banks are doing great. Banks do well when interest rates go up. And it's like, yes, but not when interest rates go up 500 basis points in a year, and they make all the loans when interest rates are super low.
Yeah.
But Patrick, so if the Fed has stopped hiking, which pretty likely that they have, the problems going forward can't be interest rate risk, right? So they have to be credit risk. So if the credit risk gets serious, the problems continue. But this whole problem of the Fed's not going to hike from 500 basis points to 1,000 basis points, right? So
yeah. So who's got the credit risk? Well, it's not really the banks. So the banks have a certain amount of credit risk, but overall, it's not the banks that have the credit risk. The people who have the credit risk really are private equity, private credit, and investors, because investors for so long have gone, let's have alternative assets. So ultimately, it negatively impacts everybody, because if they've got a pension, it may impact. We saw what happened with the gilt market. Although that was a brief hiatus of, you just look back at it and it's like Liz of 44 days. The simple chaos that was quickly resolved. But it was also, one of the things that exacerbated was the excessive amount of leverage that liability managers had in the system. Because rates stayed so low and volatility has been so low, they thought, we can double up. So we'll sort of double the size of position and be leveraged to get that extra return, until it didn't work. And the real problem is, so this could end up being more like a 2000, 2001 recession, where it effectively becomes a balance sheet recession. So households as a whole, their levels of debt are not high. It's relative, compared to where they were in 2007, they're much lower relative to income. The real problem is actually businesses. So we look at, wasn't it the federal government who massively expanded its debt during COVID, etc. It's the US business sector. We can see that data when we get the quarterly flow of funds data. So we now have a business sector in the US, or corporate debt is roughly, business debt is something like 75% of GDP. It's pretty much all-time record highs. Because the whole model was, debt is cheap. Let's go and do buybacks. We'll pay ourselves and all this sort of stuff. Well, debt isn't cheap now. So,
and you think that the duration of those borrowings was short enough for it to be a near-term problem? Because Amazon issued 40-year bonds. It's the problem of the people who lent the money because interest rates are not at zero anymore. Right?
It's not. I think we have. When we talk about whatever you want to call them, the FANGs, they are utilities. They have loads of cash. So that also leads to another problem when you hear Powell and co say, there's lots of cash in US corporates. Well, actually, if you take out the top 20 people, like Apple, like Oracle, like Microsoft, actually that level of cash is much, much lower.
Right.
And so it's a misleading approach. So corporate America is leveraged as a whole.